every dollar then is, worth making $10 or $20 later on.
Ever wondered how a few dollars today could transform into a financial empire tomorrow? It's not about hitting the jackpot, but following in the footsteps of someone who turned every dollar into millions. Dive into the intricacies of today's financial world with wisdom drawn from the Oracle of Omaha himself, Warren Buffett. He's not just a financial wizard, he's the architect of his wealth, having built it from scratch. Today, we uncover the secrets of his journey from zero to millions, exploring step-by-step insights inspired by Warren Buffett.
And so if you are interested in financial matters, getting a stake early is very useful, and getting knowledge early is very useful.
Buckle up, because we're about to discover how you can replicate his success in 2024. The Buffett Way, Core Principles. At the age of 11, he made his inaugural investment.
I bought my first stock when I was 11.
Which is incredible, that at 11 years old, you were buying your first stock.
Kickstarting a journey that would redefine the concept of wealth creation. Warren Buffett embodies successful investing. This billionaire, who made his own fortune, has constructed a vast empire by following a strategy of value investing developed over many years. Instead of chasing trendy stocks for short-term profits, Buffett's method emphasizes a long-range outlook. He sees himself as purchasing not just stocks, but actual businesses with promising futures. The essence of his strategy lies in identifying companies with inherent value, a worth that's separate from their current stock prices. Buffett stresses thorough research, examining a company's financial health, competitive advantages, and managerial prowess. He seeks out companies with a sustainable competitive edge, often described as an economic moat, which shields them from rivals and enables them to consistently generate profits. Consider brands with loyal customer bases, strong brand recognition, or cost advantages that deter competition. Buffett's philosophy goes beyond selecting the right companies. He strongly advocates for living within one's means, a principle he terms frugality. This doesn't mean living in deprivation. It's about prioritizing necessities over luxuries and avoiding unnecessary expenditures. By freeing up funds, frugality enables consistent investment, amplifying the power of compound interest over time. While this approach may seem straightforward, it demands discipline and a clear grasp of financial objectives. Ultimately, the Buffett approach emphasizes patience, discipline, and a focus on long-term goals. It's not about rapid wealth accumulation, but about steadily and strategically building prosperity over time. By embracing these fundamental principles and committing to hard work, even those starting from scratch can enhance their prospects for financial success. From Zero to Riches, your step-by-step guide. Invest in yourself. Financial literacy. Warren Buffett, renowned as one of the greatest investors in history, adheres to a principle he famously expressed: the more you learn, the more you earn. This isn't merely a catchy saying, it embodies a fundamental truth in the realm of finance. The journey towards wealth begins by investing in yourself. Becoming financially literate empowers you to make well-informed decisions about your money. There's an abundance of free resources accessible online. Government websites, educational platforms, and even YouTube channels devoted to personal finance. Supplement your learning with books authored by renowned investors such as Warren Buffett. The deeper your understanding of the financial landscape, the better prepared you'll be to seize investment opportunities. A recent survey indicated that a majority, exceeding 60% of accomplished investors in 2024, attribute their success to consistent learning and staying informed about market trends. Diversified investment options.
There are three major categories of investment. The first category is anything denominated in a currency. It can be bonds, it can be deposits in a bank, it can be a money market fund, it can be cash in your pocket. And the second category of investments regard items that you buy that don't produce anything, but that you hope someone will pay you more for later on. And the classic case of that is gold. The third category of asset is something that you value based on its what it will produce, what it will deliver. You buy a farm because you expect a certain amount of corn or soybeans or cotton or whatever it may be to come your way every year. And you decide how much you pay based on how much you think the asset itself will deliver over time.
In the early stages of his investment journey, Warren Buffett ventured into the market with a few $100s. His initial investments included shares in fundamentally sound companies like Coca-Cola in the consumer goods sector, and utility companies such as Duke Energy. By strategically spreading his investments across different asset classes and industries, the young Buffett effectively minimized the potential impact of downturns in any single sector. This deliberate diversification, with stakes in both a staple consumer goods giant and a utility providing essential services, not only reduced risk but also allowed him to gain valuable insights and practical experience in navigating the complexities of the market. It was a shrewd move that laid the groundwork for his future success, showcasing the importance of starting small and learning the ropes of investing. Strategic and informed investing is a powerful move, channeling your money to work for you and morphing your savings into a dynamic asset. The initial step in intelligent investing involves education, comprehending the fundamentals of the stock market, bonds, mutual funds, ETFs, and emerging options like cryptocurrencies. Online resources, books, and financial courses serve as valuable tools, highlighting the principle that knowledge is indeed power, especially in the dynamic world of investments. Embarking on the journey with modest beginnings is the wisest approach. Once you grasp the essentials, there's no need for a substantial initial sum. Numerous online platforms now permit investments as low as $100 or $500. The essence lies in starting and learning from genuine experiences, mirroring the initial investments of Warren Buffett, which, though modest, set the stage for his future triumphs. Diversification emerges as another pivotal element of intelligent investing. Steer clear of concentration risk. It involves spreading investments across diverse asset classes and industries. This strategic move mitigates risk and establishes a safety net to counter market volatility effectively. Armed with knowledge, it's time to navigate the investment landscape. Stocks signify ownership in a company, with their value tethered to the company's performance. Bonds act as loans extended to corporations or governments, ensuring a steady stream of interest payments. Meanwhile, index funds offer a diversified array of stocks, presenting a cost-effective approach to distribute risk across various sectors. Each avenue boasts unique advantages and risks, emphasizing the necessity of thorough comprehension, maximizing income and frugal living.
I'll show you my, this is my cell phone.
How do you tweet on that thing?
Alexander, it's falling apart as a matter of fact. No, Alexander.
Amassing wealth also necessitates attention to both earning and saving. Seek avenues to boost your income. Can you take up a side job or freelance work? Consider upgrading your skills to qualify for higher paying positions. Don't hesitate to negotiate for a raise if warranted. Now comes the crucial aspect of discipline. Devising a budget and adhering to it. Monitor your income and expenditures to pinpoint areas where you can trim expenses. Prioritize essentials such as rent, groceries, and bills over non-essential purchases like lavish dinners or the latest gadgets. Every dollar saved is a dollar you can channel towards your future investments. Warren Buffett, despite amassing immense wealth, maintained a surprisingly modest lifestyle. During the initial phases of building his fortune, Buffett continued to reside in the same house he purchased in 1958 for a mere $31,500. His approach extended to his choice of vehicles. Instead of indulging in luxury cars, Buffett opted for reliable used cars, emphasizing functionality over extravagance. Notably, his decision to select a car with airbags showcased a practical commitment to safety without unnecessary splurging. Warren Buffett's frugal lifestyle choices weren't just about saving money. They were a strategic part of his wealth-building journey. By prioritizing financial prudence over unnecessary expenses, Buffett was able to channel more funds into his investments, contributing to his remarkable success. Magic of compound interest.
Everything is cumulative. The stuff I learned when I was 20 is useful today. Not necessarily the same way and not necessarily every day, but it's useful. So you're building a database in your mind that is going to pay off over time.
Warren Buffett has emphasized the power of compounding through various statements, and one of his remarkable quotes on compounding is, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." The allure of amassing wealth lies in initiating your investment journey with modest contributions and staying committed over time. Seemingly insignificant amounts can blossom into substantial sums, courtesy of the enchanting effect of compound interest. Imagine your money earning interest on the interest it has already generated. a powerful force working to your advantage. The key is to start early and contribute consistently, regardless of your initial investment capacity. For instance, envision starting with a $500 monthly investment at the age of 30, with an average annual return of 10%. By the time you reach 60, the potential accumulation could exceed $1 million. Conversely, if you delay your investment venture until the age of 40, the resulting sum by the age of 60 would be approximately half that amount. This highlights the importance of an early start and the compounding effect, echoing the wisdom of Warren Buffett. Introduction of fractional shares for accessibility. Thankfully, you don't require a hefty sum to embark on your investment journey. Fractional shares enable you to purchase portions of expensive companies, facilitating investment in behemoths like Amazon or Google, even if their full share prices are beyond reach. With fractional shares, you can construct a diversified portfolio through smaller contributions, dispersing your risk across diverse companies. While the allure of handpicking individual stocks may be strong, diversification is pivotal for risk mitigation. Contemplate low-cost index funds as the cornerstone of your portfolio. These passively managed funds mirror a specific market index, such as the S&P 500, furnishing instantaneous diversification across numerous companies spanning various sectors. Index funds typically entail lower fees compared to actively managed funds, rendering them a cost-efficient avenue for long-term growth. A long-term investment.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses. Are those businesses going to be worth more 10 or 20 or 30 years from now? Of course they are. But if you think you can jump in and out, or that you know the time to come in, I think you're making a mistake.
Buffett's investment journey began with a focus on value investing. Instead of chasing short-term gains, he sought companies with intrinsic value. Businesses with solid fundamentals, competitive advantages, and excellent management. This approach was about investing in companies for the long haul, not quick profits. The path to wealth is characterized by patience and discipline. The stock market exhibits inherent volatility, marked by periods of both ascent and descent. Refrain from succumbing to panic selling during market downturns. Recall Buffett's advocacy for a long-term outlook. Such downturns are often transient, and historical data illustrates the market's ability to rebound and resume its upward trajectory over time. Maintain composure, resist selling at a loss, and have faith in your investment strategy. Nonetheless, periodic reassessment of your investments remains imperative. Monitor your portfolio's performance, but refrain from making impulsive decisions based on short-term fluctuations. Periodic rebalancing of your portfolio may be necessary to uphold your desired asset allocation. However, resist the urge to incessantly intervene. Remember, you're in it for the long haul. Reinvest profits. Embark on the final leg of our journey to wealth, starting from ground zero in 2024, and walk in the footsteps of Warren Buffett. This pivotal stage hinges on the strategic move of reinvesting your profits, a rock of Buffett's towering success. Instead of splurging the returns from your investments, channeling them back into the market fuels the exponential growth of your wealth over time. Consider this. Invest $15,000 with a 10% return, and you pocket $1,500. Reinvest that $1,500, and now your earning returns are $16,500, not just your initial $15,000. This compounding effect can snowball into substantial growth in your investment portfolio. In the dynamic landscape of 2024, ripe with various investment avenues, reinvesting profits manifests in multifarious forms. It might entail reinvesting dividends from stocks, or interest from bonds, or redirecting profits from one venture to fuel another, thus diversifying your holdings and mitigating risk. A pragmatic approach to reinvesting profits is through a DRIP, or dividend reinvestment plan, or a similar mechanism. Many corporations extend these plans, automatically funneling your dividends back into additional shares, often without incurring transaction fees. This seamless process turbocharges your investment growth. Yet, the journey doesn't stop here. Continuously enrich your knowledge and stay attuned to market dynamics. The road to financial independence requires perpetual learning. Tap into abundant resources like Warren Buffett's The Intelligent Investor and websites such as investor.gov for beginner-friendly insights. Explore financial news websites and podcasts for specific investment strategies. Establish an investment account with a user-friendly broker, taking advantage of commission-free trades for even modest contributions. Budgeting is paramount. Use apps to monitor income, trim expenses, and allocate funds to savings. As investments grow over time, Warren Buffett's journey attests that starting from $0 in 2024 is entirely possible to build significant wealth. Share your first financial step in the comments, inspiring others in their journey to success.